of Absa Group, currently standing by to look at those results which were released yesterday. Maria, a very good morning to you.
Good morning. How are you, Stephen?
Good, thank you, Maria. First of all, maybe just touching on the PR nightmare you had yesterday with those results coming out a day early, and of course in the Financial Mail, which actually hit the shelves a day earlier. A bit of a nightmare for Absa, I'm sure. How did you handle that?
Well, Stephen, I think we just want to make it quite clear that we have taken the matter very, very seriously. We are doing a full investigation, and once we have done that investigation, we will communicate with the market and the relevant authorities. For now, we are doing an investigation, and today is about the results as we had planned them, and so that's going to be our focus.
Well, we were saying yesterday, Maria, it's Alicia speaking, that much of the surprise was taken away by the trading update released on Friday. In any event, headline earnings per share coming down 4%. The concern, though, is around outlook moving forward, where you're saying we're looking at a pretty tough second half year.
Well, I think we have said that the environment remains challenging. The economy is growing, and we obviously it's a better environment than it was last year. But having said that, it's still a challenging environment for consumers. We are still seeing corporates in an environment where they're not investing, and we remain cautious. The global environment and the global recovery is muted and uncertain, and so we really are quite cautious and managing the business appropriately from that perspective. We think that where the opportunities are, we are taking them, but it is a rather more muted environment than we probably would have expected earlier on in the year, when the sovereign debt crisis in Europe wasn't immediately obvious, and it looked like we were going to see a little bit more global growth.
Maria, good morning. It's Graham Kerner. I just wanted to get your sense on the absolute debt levels. If we took the households in South Africa, we've seen a major increase in, say, debt to disposable income over the last 5 years. What role do you think absolute debt levels is playing in sort of holding back the economic recovery? Talking firstly about South Africa and households in South Africa, and then maybe taking that to the rest of the world.
Well, we've seen an improvement in that. I think debt to disposable income peaked at 83.4%, I think, in 2008. That's come down to currently 78.4%. So we are starting to see that improve, but off a very high base. And so what we know from past recessions is that people are cautious. They do, as incomes rise, and we've seen incomes rise because of relatively high wage settlements, and because interest rates have come down very significantly. People are being sensible. They are paying back debt. They are stabilizing personal balance sheets, and but that does take time. So the environment is improving from a personal balance sheet and a personal debt indebtedness point of view. If you look globally, the environment, the signals remain pretty mixed. I mean, you look at the US and you get 1 or 2 months of good and improving data, and then it all changes. And so you look at the US housing market and the recovery there, the recovery just isn't there. You've seen improvements in savings in the US, in personal balance sheets, in personal savings in the US, but you're not seeing the kinds of improvements in the employment environment in the US in order to sustain a solid recovery in that economy. And you need a solid recovery in the US economy in order to drive a solid global recovery. You're looking at Europe, and the European Union economies are not in good shape. So, you know, it's still going to be quite a challenging environment for quite a bit of time. And I think that's what makes everybody a little bit cautious.
Just another question, something that I found strange is non-performing loans continue to rise and yet the impairment charge went down. Could you just shed a bit of light on that, please?
Well, I think if you look at what's happening in the early cycles, in the 1 to 3 months of our book, across the piece. So on the retail side, we are starting to see an improvement in that part of our impairment, in the impairment performance there, and therefore you're beginning to see the benefit of that in terms of the impairment charge. But you know, you are starting to see in the flow into legal, if you look at the a higher flow into legal, and then you're also starting to see the impact of the debt counselling coming through, and that impacts the charge into the non-performing loans.
Well, Maria, you talk about slack demand for loans at the bank. How much of this is due to Absa being cautious with its lending and pricing for risk, and how much due to customers not wanting to borrow? Because although we have had 550 basis points cut off interest rates, not all of that has gone to customers. You are still pricing for risk in this market.
I didn't get the early part of the question, sorry.
How much is the slack demand for loans due to Absa being overly cautious and pricing higher for risk to customers?
Well, I think, you know, we must take account of the fact that demand for credit is pretty muted. So that remains a big issue in this market. I think we have also got to be responsible lenders. So that's the other factor here. We have started to relax our lending criteria, particularly to our own clients, to our own Absa clients. And obviously, you know, this remains a challenging environment. So we can't just, you know, you don't want to just go out there and open the floodgates, and in an environment where we are still not out of a difficult economic situation. So we have actually started relaxing. We are pricing better for risk, so we are able to do that a lot better. But the demand just isn't there as well. So it's a combination of all of those.
Subdued, you know, loans and advances looking subdued, fees and commissions also on that same playing field. We've got a cost-to-income ratio back above 50 at 54%. How, in this positioning of the business for future growth, let's just very quickly touch on your Africa strategy and possible interest in Nigeria.
Well, let me say on the Africa side that we have now got the license to open the rep office in Nigeria, so we are proceeding with that. We are continuing, in addition to that, to look at opportunities in Nigeria. I think I've said that before. So we are actively looking. It has to be value accretive, so we're looking at that space with keen interest. We're setting up, as I say, the rep office. If you look at Absa Capital, you'll see that our revenue from Africa has improved very strongly in that space. We've gone from just over 80 million rand to 144 million rand. We are going to be doing the IPO in Tanzania, and we've got a date for completion in the first quarter of next year. So we are actually doing solid bits of activity in Africa. And then in bank assurance, we are looking at inorganic opportunities across the piece. So there is quite a lot of activity on our radar screen in Africa.